The concept of digital currency has its roots in the cypherpunk movement, which emerged in the late 20th century. Pioneers aimed to develop secure and private digital cash, emphasizing financial autonomy. Early efforts encountered significant technical challenges, particularly in achieving true decentralization and solving the double spending problem. These initial struggles laid the groundwork for future innovations. Before Bitcoin, several digital cash systems emerged, attempting to create secure online transactions. Notable examples include eCash by David Chaum, DigiCash, and B-Money. These systems leveraged cryptography to ensure privacy and prevent double spending. However, their fundamental flaw was often their centralized architecture, introducing vulnerabilities such as single points of failure, potential censorship, and lack of true anonymity. This limited their ability to achieve widespread adoption and gain public trust, paving the way for a truly decentralized solution like Bitcoin. In his 2008 white paper, Satoshi Nakamoto introduced Bitcoin, a peer-to-peer electronic cash system. It solved the double spending problem without central authority, marking a paradigm shift. Bitcoin's launch on January 3, 2009 was a historic moment, ushering in the era of decentralized digital currencies and blockchain technology. This fundamentally changed financial technology. Bitcoin introduced a revolutionary concept: decentralization. This means that no single bank, government, or corporation has control over the network. Instead, transactions are verified and recorded by a global network of independent participants. This distributed control is fundamental to Bitcoin's censorship resistance, transparency, and overall security, marking a significant departure from previous digital currency attempts. Blockchain is a distributed public ledger. Each block contains transactions, and once validated, it's added to the chain. This creates an immutable record, fundamental to secure digital assets and decentralized systems. A consensus mechanism allows validators to agree on transaction validity. This forms an immutable, cryptographically linked blockchain. Smart contracts are self-executing code blocks that enable trustless automated interactions. The system ensures secure, transparent, and tamper-proof management of digital assets. Blockchain's core is a chain where each block contains transaction data and is cryptographically linked to the one before it, forming an immutable history. This structure makes it highly secure and tamper-proof. The distributed ledger aspect means every network participant has an identical copy. Any change is visible and validated across the entire network. At the core is a chain of blocks. Each block is linked to the previous block. This linkage ensures immutability. Any tampering breaks the chain's integrity. Cryptocurrency mining serves two essential functions: introducing new coins and validating transactions. Miners use powerful computers to solve complex mathematical puzzles. These puzzles are part of the proof-of-work mechanism, requiring significant computational effort to find a valid solution. Once solved, the miner earns a reward, new coins, and the validated transactions are added to the blockchain. This process ensures network security, prevents fraudulent activity, and maintains blockchain integrity. Every successful mining operation strengthens trust in the network and upholds the transparency and immutability of the ledger. Proof-of-work process. Miners utilize powerful computers, ASIC, and GPU, to solve complex mathematical puzzles. Successful miner achieves two key goals. They validate transactions to secure the network, thereby ensuring blockchain integrity and fraud prevention, and they receive a reward, effectively minting new crypto coins and introducing them into circulation. This constant competition for rewards motivates miners to maintain the network's security and processing power, making the system decentralized and resistant to fraud. Following Bitcoin's initial success, a wave of innovation led to the creation of altcoins. These alternative cryptocurrencies were developed with the intention of addressing perceived limitations of Bitcoin or introducing novel features. Early pioneers like Litecoin focused on faster transaction times, Namecoin on decentralized domain registration, and Purecoin on a unique proof-of-stake system, marking the initial diversification of the cryptocurrency market. The evolution and diversification of altcoins beyond Bitcoin, highlighting three prominent examples: Ethereum, Ripple, and Cardano. In 2015, Ethereum enabled smart contracts and decentralized applications, expanding the utility of digital assets. In 2012, Ripple focused on fast, low-cost international payments. In 2017, Cardano emphasized a research-driven approach to blockchain development, prioritizing scalability, sustainability, and academic rigor. The significant advantages and innovations brought by altcoins is expanding blockchain utility. Key benefits include faster transactions, lower fees which reduce transaction costs, and enhanced privacy features like confidential transactions and anonymity. These improvements collectively contribute to expanding blockchain utility, driving innovation in areas such as decentralized finance for lending and borrowing, NFTs for digital ownership, and digital identity. Significant dangers are associated with investing in altcoins. Firstly, higher volatility is a major concern characterized by price swings and a susceptibility to market manipulation. Secondly, inherent risks encompass a range of serious issues, including rug pulls and scams, prevalent lack of liquidity that makes buying and selling difficult, ongoing regulatory uncertainty, and the potential for technological failure. Together, these factors lead to substantial investor pitfalls. This underscores the need for extreme caution when considering altcoins. In 2013, Bitcoin saw its initial major price bubble, soaring from $13 to over $1,100 by December. This rapid ascent, largely driven by speculation, was followed by a dramatic crash, typical of a boom and bust cycle. This period critically demonstrated the extreme volatility inherent in nascent cryptocurrency markets. It highlighted the significant influence of speculative trading on prices and set an important precedent for understanding future crypto market dynamics and investor behavior. The Mt. Gox incident stands as one of the most notorious events in cryptocurrency history, severely impacting Bitcoin's early reputation. Once the largest Bitcoin exchange handling over 70% of all transactions globally, Mt. Gox experienced a catastrophic collapse in early 2014. Around 850,000 Bitcoins, valued at around $450 million at the time, were reported missing. The incident sent shockwaves through the nascent crypto market, causing Bitcoin's price to plummet and eroding investor trust. In 2015, the blockchain landscape underwent a significant transformation with the launch of Ethereum. This platform introduced the groundbreaking concept of smart contracts, which are self-executing contracts with the terms of the agreement directly written into code. This innovation enabled developers to build decentralized applications on the Ethereum network, ranging from financial tools to gaming platforms. Ethereum truly set the stage for blockchain's broader utility beyond just digital currency. Bitcoin made history by soaring to an all-time high price of $126,080 on October 6, 2025. The price surge was fueled by a convergence of factors, including increasing institutional adoption, heightened retail investor interest, and prevailing macroeconomic trends that encouraged investment in decentralized digital assets. This record-breaking achievement underscores the exponential growth and maturity Bitcoin has experienced since its inception. Blockchain technology and cryptocurrencies are moving beyond simple digital currency to power a vast array of practical real-world applications by leveraging their core features: decentralization, security, and immutability. This technology is being adopted across diverse sectors, including supply chain management, healthcare, and finance. The use of smart contracts automates workflows, eliminates the need for costly intermediaries, and ensures unparalleled trust and efficiency in transactions. The foundation is a tamper-proof digital ledger that is revolutionizing how we handle data, assets, and agreements. We can expect to see further integration into traditional financial systems. The blockchain technology will continue to mature and unlock even broader practical applications, such as digital identity, intellectual property rights, and decentralized autonomous organizations, DAOs. Ultimately, The future holds the promise of a more interconnected and decentralized digital economy, where cryptocurrencies serve not just as currencies, but as building blocks for a new era of digital interaction and value exchange. Thank you for watching, and see you next time.